Hello everyone, I'm Serge Sen. As Jonathan mentioned in the previous segment, today's video presentation will focus on those provisions of the LO Comp rule about which we have heard the most questions. While there are several parts to the rule, its primary purpose is to address concerns about the incentives that loan originators may have to steer consumers into more expensive mortgage loans in order to increase their own compensation. The rule addresses these concerns in primarily two ways. First, the rule prohibits steering in connection with a consumer credit transaction secured by a dwelling. This means that a loan originator must not coax or steer a consumer to take a loan based on the fact that the originator will receive greater compensation from the creditor than in other transactions the originator offered or could have offered to the consumer unless the consummated transaction is in the consumer's interest. Second, the rule prohibits a loan originator from being compensated based on the terms of a mortgage transaction or a proxy for the transaction term. Thus, any monetary incentive to influence loan terms is removed from the transaction. In addition, the rule prohibits dual compensation, meaning loan originators being compensated by both the consumer and another person, such as a creditor in the same transaction. Prohibits mandatory arbitration clauses and waivers of certain causes of action, prohibits the financing of credit insurance. This prohibition does not include mortgage insurance, requires that depository institutions have written policies and procedures to monitor compliance with the rule, imposes qualification requirements on loan originators, requires that the name and NMLSR identification information of the loan originator with primary responsibility for the transaction appear on the credit application, note, and security instrument. And lastly, the rule permits, within limits, paying loan originators compensation based on profits derived from a bank's mortgage-related activities. Bank includes an affiliate of the bank and/or a business unit within the bank or affiliate. Now I'll turn it over to my colleagues, Glenn Gimble and Elizabeth Khalil.
Thanks, Serge. As we begin to talk about the rule's compensation provisions, let's start with the most basic requirement. For any loan that is a covered transaction, no loan originator can receive and no person can pay to a loan originator, directly or indirectly, compensation in an amount that is based on terms of transactions or proxies for terms of transactions, either of a single loan originator or multiple loan originators. Let's break down that requirement, since it contains a number of important terms. A covered transaction is a consumer purpose, closed-end transaction secured by a dwelling, whether by a first or subordinate lien. It includes reverse mortgages, condominiums, and cooperatives. A loan originator is any person who, for or in expectation of compensation or other monetary gain, engages in certain specified activities. Thus, the loan originator definition could potentially include anyone involved in the loan origination process, not just those who consummate the transaction. That's why it's so important to give attention to the actions of every person that touches the origination process. As we'll discuss in a bit, when we review the two categories of loan originators, the bank itself can become a loan originator under the rule. So, just what are the activities that would make someone a loan originator? The rule lists several loan originator activities, including taking an application, offering particular credit terms, or referring a customer to a particular loan originator, or assisting a consumer in obtaining or applying for a covered mortgage loan by advising on specific credit terms. Let's discuss in a little more detail what each of these loan originator activities could mean.
First, let's briefly discuss what is meant by taking an application. A person takes an application when he or she does any of the following: fills out a consumer application, inputs the information into an online or other automated system, or takes information from the consumer over the phone to complete the application. But a bank employee who simply provides a consumer with the bank's credit application form or delivers the consumer completed form to the bank or the bank's loan originator is not taking an application under the rule. Now, let's briefly touch on what is meant by offers terms of a mortgage loan. Offering terms of a mortgage loan includes presenting particular credit terms for consideration by a consumer, or recommending or referring a consumer to a particular loan originator, creditor, credit terms, or credit product. A teller or greeter simply communicating general, publicly advertised credit terms, for example, off the bank's lobby reader board or from a published newspaper ad, is not considered offering terms of a mortgage loan under the rule. Further, tellers or greeters don't refer a consumer under the rule unless they affirmatively influence the selection of a particular loan originator based on information obtained from the consumer. It's this affirmative influencing of the consumer based on information about the consumer that gives rise to the loan originator activity of referring a consumer. Let's now turn our attention to what is meant by assists a consumer by advising on specific credit terms. Assisting a consumer under the rule includes advising on specific residential mortgage loan terms, preparing residential mortgage loan packages, or collecting information on behalf of the consumer with regard to a residential mortgage loan.
We've received many questions as to whether it counts as assisting when a teller or greeter, in response to a consumer's inquiry, simply offers general information about the mortgage application process or guidance with respect to the mechanics of completing an application form. The answer is no. A person does not assist a consumer in completing an application form if the person merely explains to the consumer the contents of the application or where particular consumer information is to be provided. Nor does such person become a loan originator by providing general information about the application process without discussing particular credit terms that may be available to that particular consumer based on that consumer's particular financial characteristics.
Now, some of you might be thinking that this definition of loan originator differs somewhat from the definition of mortgage loan originator you're familiar with under the SAFE Act. Well, you're right. The definition of loan originator under the LO Comp Rule is broader than the definition of mortgage loan originator under the SAFE Act, in that it captures anyone in the mortgage origination process who, for or in expectation of compensation, engages in loan originator activities. In its Small Entity Compliance Guide, the CFPB notes that the broad definition of loan originator under the LO Comp Rule reflects the intent of Congress to ensure consistent regulation of a broad range of persons that may have financial incentives and opportunities to steer consumers to particular credit transactions or terms early in the origination process.
So who is not a loan originator? The LO Comp Rule identifies several categories of people who generally are not loan originators under the rule. Among them are a person who, acting on behalf of a loan originator, engages in loan processing activities. For example, a processor, underwriter, or closer. A servicer or servicer's employee, unless loan origination activities are performed in connection with a refinancing. However, renegotiating or modifying an existing mortgage is not a loan originator activity under the rule. And, as discussed earlier, a person who performs purely administrative or clerical tasks on behalf of a loan originator or simply provides a mortgage application form to a consumer or returns the completed form to the creditor or originator.
As we noted, we've heard many banks express some ongoing challenges in identifying the line between its employees engaging in loan originator activities and non-loan originator activities. To help, we've prepared a short animated tutorial that we hope will help demonstrate that line in the context of a bank teller and/or greeter. After each vignette, we'll discuss whether the actions we just observed constitute loan originator activities or not.
Hi, welcome to the Bank of Anytown. How can I help you today?
I'm shopping for a new home. Can you tell me if this bank offers home mortgage loans?
Yes, we do. As you can see, we offer several types of home mortgage loans to meet the needs of our customers.
Can you tell me the current interest rate on your 30-year fixed home mortgage loan?
I'm sorry, but I am not the person you need to talk with to discuss interest rates or specifics regarding our home mortgage loans. Sarah is our home mortgage specialist. If you have time right now, I can see if she is available to meet with you.
I'm actually on my way to work and don't have time right now to meet with anyone. Could I get an application and drop it off tomorrow?
Sure, here is an application. Complete it when you have time and bring it back at your convenience. After you return it, I will give it to Sarah and she will contact you directly to discuss your options.
That sounds great. Thank you for all your help.
In this scenario, has the teller engaged in a loan originator activity by giving the customer a home mortgage application form? The answer is no.
Why is the answer no? Well, the definition of a loan originator does not include the activity of an employee, such as a teller, of simply providing an application to a consumer or simply accepting a completed application from the consumer, as long as the employee does not assist the consumer in completing the application or otherwise influence his or her decision.
The definition also does not include employees simply delivering a completed application to a loan originator or creditor without doing any of the following: assisting the consumer in completing the application, analyzing the consumer's information or discussing specific credit terms or products available to the consumer based on the specific financial characteristics of the consumer.
So that was a fairly straightforward example. Now let's look at another scenario. This takes place after the customer has accepted the blank application form from the teller or greeter and gone home. Let's see what happens next.
Hi, welcome back. Are you here to drop off your home mortgage application?
I really appreciate all your help yesterday. I worked on my home mortgage application last night, but could not figure out how to complete a couple of the sections. Is there anyone available who could answer a couple of questions?
I'm really sorry, but our home mortgage specialist is out of the office until later this afternoon. Is there any chance you could stop back around 2 o'clock?
No, I can't. Today is my day to pick up the kids from daycare. I really need to get this process started as soon as possible. Could you help me complete this application?
I am really not the person you need to talk with to complete a loan application.
I'm not looking for someone to qualify me. I just need some help with the terminology on the application and some guidance on how to enter my information. Please, I only have a small window of time to figure out my financing options.
Okay, let me take a look at your application and see what I can do.
In this scenario, has the teller engaged in loan originator activity? The teller says, "Let me look at your application and see what I can do." It really matters what happens next. If the teller assists the consumer by simply explaining terminology on the application or placement of information, the teller has likely not engaged in loan originator activity. If, on the other hand, the teller assists the consumer in completing the application in some substantive way, the teller will likely become a loan originator if the teller engages in this activity for or in expectation of compensation.
So for example, if the customer does not understand what the application form means by income, the teller could explain that that includes salary payments, for instance. Or the teller could literally translate words and phrases on the application for a customer for whom English is not their first language. These activities would not rise to the level of a loan originator activity. By contrast, if the teller started getting into what the customer should provide in response to questions on the loan application, this would cross the line into loan originator activity. And again, if a person engaging in loan originator activity does that activity for, or in expectation of, compensation, they will become a loan originator covered by the LO Comp rule. Now let's look at our last scenario.
Hi, how are you doing today? How can I help you?
2 days ago, I found the perfect home and made the sellers an offer. Last night, I found out my offer was accepted. I really need to discuss my financing options with Sarah, your home mortgage specialist. I dropped off my mortgage application over a week ago, but still haven't heard from her. I need to know today if I would qualify for a loan with your bank, the costs involved, and my potential interest rate.
I'm really sorry you haven't been able to connect with Sarah. She is out of the office today, but will be back tomorrow.
I can't wait until tomorrow. I need to know if I have been approved for financing by the end of today. Is there anything you can do to help me?
Normally, I would never do this, but I'm familiar with our bank's underwriting standards and pricing guidelines. I'll grab your application and supporting documentation off Sarah's desk and run a quick analysis for you. I will be able to tell you if you will be approved for financing and what rate we will be able to offer you. However, I will not be able to provide you with an official pre-approval letter. Let me go grab your file.
Thank you.
Good news! After analyzing your application, credit report, and employment history, we will be able to offer you a 30-year fixed loan at a rate of 4.25%. Again, I can't provide you with a pre-approval letter, but I can have Sarah type that up when she returns tomorrow.
That is great news. You just made my day.
In this scenario, is the teller engaging in loan originator activity? The answer is yes. Here, the teller did more than just simply receive the application from the customer and hand it to a loan originator. Here, the teller actually analyzed the application and communicated a decision to the customer.
Contrast the activity in this scenario with the scenario in which the teller simply acts as a greeter, pointing the customer to the loan origination department down the hall. In this scenario, the teller is taking an active role in analyzing the customer's application and offers loan terms based on the customer's financial characteristics. That's clearly loan originator activity.
Glenn, what about the fact that the teller specifically says that he can't provide the customer with an official pre-approval letter, that only the official loan originator can do that? Does that matter here?
That's a great question. The answer is no. The teller analyzed the application, credit report, and employment history and made the determination of what loan type and interest rate the customer qualifies for. That's clearly enough to say the teller is engaging in loan originator activities. This is true even though this is not part of the teller's usual duties, and even though a different employee is the one with authority to issue an official pre-approval letter.
That makes sense. Don't forget to keep in mind, though, that the inquiry doesn't stop there. Just because someone is engaging in loan originator activity, they won't be considered a loan originator subject to the rule unless they're engaging in that activity for or in expectation of compensation. Again, whether someone is a loan originator or not requires a two-part test. First, is loan originator activity being engaged in? And second, is that activity being engaged in for or in expectation of compensation? This analysis can be particularly tricky where the activity is not part of the employee's usual duties. You must ask yourself, why is the employee engaging in this loan originator activity? The answer will determine whether or not they will be subject to the LO comp rule.
We hope our tutorial was useful in better understanding when and under what circumstances members of your frontline staff may become loan originators subject to the LO comp rule. But before we conclude our segment on who is and who isn't a loan originator, let's quickly review the two categories of loan originators under the rule. Certain statutory requirements under TILA require a distinction between loan originators that are natural persons and those who are organizations. Thus, the LO comp rule creates two new categories of loan originators to reflect this statutory distinction: individual loan originator and loan originator organization. An individual loan originator is a natural person who meets the definition of a loan originator, as previously discussed. A loan originator organization, by default, is any loan originator who is not an individual loan originator, such as trusts, sole proprietorships, partnerships, corporations, and banks when they broker loans or when they don't use their own resources to fund a mortgage loan, commonly referred to as table funding.
Why two categories of loan originators? By differentiating between an individual loan originator and a loan originator organization, the CFPB enables a loan originator organization to share the compensation it receives in a particular transaction, for instance, a loan origination fee, with its individual loan originator without fear of violating the LO comp rule. Without this clarification, such payment to the individual loan originator could be viewed as being based on a term of a transaction, namely the loan origination fee. We'll review what constitutes loan terms shortly. The LO comp rule makes clear that a loan originator organization is not paying compensation based on a loan term when it shares its loan origination fee with its individual loan originator. Before we move on from our discussion of loan originator organizations, it's important to note that all creditors, including FDIC-supervised banks, are always considered loan originator organizations in all transactions for purposes of the qualification and unique identifier provisions of the LO comp rule, regardless of how they fund their mortgage loan transactions. Please refer to the resource slide at the end of this presentation for where to find information about the qualification and identification provisions of the LO comp rule.
Let's now turn our attention to what is compensation under the rule. The LO comp rule defines compensation as salaries, commissions, stocks, and any financial or similar incentives, such as bonuses or awards of trips or merchandise. It also includes any loan fee or part of a fee the loan originator retains, regardless of the label or name of the fee, such as a processing fee. Compensation does not include bona fide and reasonable charges passed on to a third party, such as for credit reports or paid to a loan originator for services performed that are not loan originator activities, such as for title insurance.
When are third-party charges considered bona fide and reasonable? The fact that a transaction for third-party services is conducted at arm's length should be sufficient to demonstrate that the charge is reasonable. The CFPB clarified this in response to concerns that the reasonableness standard for charges passed on to third parties may be second-guessed. What about amounts received for third-party charges that exceed the actual charge when the excess is retained? Is that compensation? Where amounts received for third-party charges exceed the actual charge, the loan originator organization may use an average cost for the service when it cannot determine with accuracy what the actual charge will be at consummation. In such case, the difference retained by the loan originator organization is not compensation if the charge to the consumer was bona fide and reasonable and complies with state and other applicable law. On the other hand, if the loan originator organization knows the amount of the charge, marks it up, and retains the difference between the actual charge and the marked up charge, the amount retained is compensation and subject to the requirements of the LO comp rule. Remember, creditors are not subject to the rule's compensation provisions, as they do not meet the definition of loan originator or loan originator organization under the rule. Nevertheless, marking up and retaining third-party fees raises compliance concerns under other regulations, such as RESPA.
We hope this segment has helped you understand some key points of the LO comp rule, including who is and who isn't a loan originator under the rule. In the next segment, we'll discuss in more detail the rule's compensation provisions.